Have you ever wondered what a bank bail-in is and how it impacts you? It's a question that might not cross your mind every day, but when it does, it's certainly worth a moment of thought. A bank bail-in is not your usual financial rescue plan. It's a strategy that enables a failing bank to receive support, not from external governmental assistance, but from its own creditors. It's like a self-help group for banks where the members are the creditors themselves. Rather than waiting for a knight in shining armor to swoop in and save the day, the bank turns to its own resources, rallying its creditors to pitch in and help save the day. This concept was thrust into the limelight during the Cyprus bank bail-in incident, sparking global attention and curiosity. Now that we understand what a bank bail-in is, let us delve deeper into how it works. So you might be asking, how does a bank bail-in work? Well, let's dive in and unravel the mechanics together. Picture this. A bank is on the brink of collapse. Its financial health is deteriorating and it's failing to meet its obligations. In such a scenario, a bail-in comes into play. Unlike a bailout where the government steps in to rescue the bank by injecting taxpayer funds, a bail-in involves the bank's creditors. These creditors, who may include depositors, are forced to bear some of the burden. This could mean having a portion of their funds written off or converted into shares in the bank. So in essence, a bail-in is a way to recapitalize the bank from within, using its own stakeholders' resources. This strategy is designed to keep the bank afloat, maintain financial stability, and, importantly, avoid the need for public funding. Now, this might be making some of you a tad nervous. After all, the term creditors includes depositors, right? That's you and me. But let's inject a dose of relief into the mix. In the United States, deposits in banks are insured by the Federal Deposit Insurance Corporation, or FDIC for short. This insurance covers up to $250,000 per depositor per bank. So if you're a depositor with less than this amount in your bank, you can breathe easy. Your funds are protected even in the case of a bank failure. But remember, since the financial crisis of 2008, most countries around the world have adopted laws and guidelines on how to execute bail-ins. For instance, the US Congress passed the Dodd-Frank Wall Street Reform and Consumer Act in 2010, which includes provisions for bail-ins. It's clear then, a bail-in is designed to lessen the strain on taxpayers. But when did this all start? Let's explore that in our next scene. The concept of bank bail-ins isn't as new as you might think. In fact, the origin of bail-ins can be traced back to the aftermath of the 2008 financial crisis. The crisis exposed the vulnerability of the banking sector, leading to an urgent need for an effective mechanism to rescue failing banks. In response, most countries around the globe took steps to adopt laws and guidelines on how to execute bail-ins. For instance, in the United States, the Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. This legislation created a framework for the orderly liquidation of failing financial institutions, thus minimizing the risks to taxpayers and the broader economy. It's worth noting that the US deposits in banks are insured by the Federal Deposit Insurance Corporation, up to $250,000 per depositor per bank. This history shows us how bail-ins have become an important part of the financial landscape. But what does a bank bail-in mean for you, the depositor? Well, it's a complex scenario. If you're an insured depositor in the United States, for instance, your deposits are safeguarded by the Federal Deposit Insurance Corporation, up to a limit of $250,000 per depositor per bank. So, in the event of a bank bail-in, your money up to that limit is safe. However, if you're an uninsured depositor, things can get a bit dicey. You could lose a portion of your deposits during a bail-in. This is because a bail-in involves the restructuring of a bank's liabilities, which could mean turning your deposits into shares in the bank. This is why it's crucial to understand the banking system and the financial health of the bank where you deposit your money. It's not just about where you store your cash, but also how safe it is there. Remember, knowledge is power, especially when it comes to your hard-earned money.